Hello everyone. Welcome back. Today, we've got some crucial news you don't want to miss. Let's dive right into the top financial headlines and break down what's happening. Wall Street rallies around Scott Bessent, a rare market reaction. In an unusual turn of events, Wall Street attributed today's market movements to one individual, Scott Bessent, President Trump's nominee for Treasury Secretary. Such singular influence is rare in the financial world, where market shifts are typically driven by major events. However, Bessent's recent comments during an interview with the Wall Street Journal sparked optimism, leading to a simultaneous rally in U.S. stocks and bonds, an uncommon and significant occurrence. To understand the dramatic impact of Bessent's nomination, here are 4 key perspectives from major outlets. 1. Wall Street Journal, a dual market rally. The Wall Street Journal reported that both the Dow Jones Industrial Average and U.S. Treasury bonds surged as investors celebrated Bessent's nomination. Announced by Trump last Friday, the pick reassured markets that Bessent could temper the administration's more aggressive trade and economic policies. In his interview, Bessent emphasized his commitment to Trump's tax cut agenda and called for a more balanced approach to tariffs. Investors interpreted his comments as signaling that Trump's economic policies, particularly on trade, might not be as radical as his campaign rhetoric suggested. This sense of stability is highly valued by Wall Street, which prefers predictability over uncertainty. 2. Reuters, a global market rebound. Reuters echoed the sentiment, noting that Bessent's nomination not only buoyed U.S. markets but also triggered a global rebound. Stocks and bonds around the world saw gains as fund managers welcomed his moderate stance on tariffs and fiscal responsibility. Bessent's opposition to extreme tariff hikes suggested a de-escalation in U.S. China trade tensions, which markets viewed positively. His comments provided hope that negotiations between Beijing and Washington could proceed without major disruptions. 3. Bloomberg, the China connection. Bloomberg delved deeper into why Bessent's nomination resonated so strongly with markets, particularly in relation to U.S. China trade policy. Bessent's call for phased tariff increases and opposition to extreme measures reassured investors that the trade conflict might not escalate dramatically. Bloomberg argued that Bessent's views would benefit China the most, as his moderate stance offers Beijing more room to negotiate. Analysts believe his approach will avoid sudden and destabilizing shifts in trade policy, a prospect welcomed by global investors seeking stability. Moreover, Bloomberg highlighted the broader implications of Bessent's nomination, noting that his presence in Trump's cabinet adds a moderating voice against the administration's more hawkish trade advisors. This balance is seen as crucial for maintaining economic predictability. 4. CBS News, who is Scott Bessent? The CBS News provided a closer look at Bessent's background, which offers valuable insight into his potential influence. Born into a wealthy real estate family in South Carolina, Bessent graduated from Yale with a degree in political science before building a distinguished career in finance. His close ties to George Soros, for whom he worked as a senior fund manager, have drawn attention. Bessent later launched his own asset management firm with Soros backing but eventually returned to Soros' firm as CFO. Despite his historically Democratic affiliations, Bessent began shifting his support toward Republicans in recent years, aligning with Trump's economic vision. A defining feature of Bessent's policy approach is his 3-3s plan. 3% GDP growth, advocating for sustainable economic expansion without overheating. 3% budget deficit as a share of GDP, reducing the current 6% deficit to manageable levels. 3 million barrels of daily oil production growth, enhancing U.S. energy independence. While ambitious, questions remain about whether Bessent can convince Trump to prioritize deficit reduction, given the administration's tolerance for rising debt. Notably, Bessent's appointment marks a milestone as he becomes the first openly gay cabinet member requiring Senate confirmation in Trump's administration. His personal life reflects Trump's willingness to defy some conservative norms, as seen in previous appointments like Richard Grenell. The bigger picture. Bessent's nomination has broader implications. His moderate stance on tariffs and focus on fiscal stability are seen as a counterbalance to more hawkish voices in Trump's cabinet. Investors welcomed this balance, believing it reduces the likelihood of extreme trade measures that could destabilize markets. Today's market reaction underscores a rare moment in which one individual's nomination shifted global sentiment. While challenges remain in implementing his vision, Bessent's appointment signals a potential shift toward more measured economic policies under the Trump administration. Let's turn our attention next to America's Asia-Pacific ally, the Philippines. The Philippine political scene has been thrown into turmoil following a shocking accusation by Vice President Sara Duterte, daughter of former President Rodrigo Duterte. She claimed that current President Ferdinand Marcos Jr., son of the late dictator Ferdinand Marcos, is plotting to assassinate her. Furthermore, she warned that if such a plot succeeded, she would ensure retaliation against Marcos. This explosive allegation has not only stunned the Philippine public but also attracted significant international attention. A detailed report from Bloomberg sheds light on the origins and implications of this intense political conflict. From allies to adversaries, the roots of the rift. Once electoral allies, Marcos and Duterte have now become fierce rivals. The conflict stems from two primary issues. Divergent foreign policies. President Marcos has reversed many of the pro-China policies of Duterte's father, Rodrigo Duterte. Under Marcos, the Philippines has aligned more closely with the United States and taken a stronger stance against Beijing regarding territorial disputes in the South China Sea. Corruption investigations. Vice President Duterte resigned from Marcos's cabinet in July 2024 amidst growing tension. Currently, the Philippine Congress is investigating her alleged misuse of public funds, further straining relations. Duterte has publicly criticized Marcos and even threatened to exhume the remains of his father, escalating their feud. How did it escalate to assassination threats? According to Bloomberg, the situation worsened as scrutiny intensified around the Duterte family. Former President Rodrigo Duterte is now facing congressional investigations into his controversial anti-drug campaign, which involved alleged extrajudicial killings. The Marcos administration has also signaled possible cooperation with international authorities to probe these actions. Feeling cornered, Vice President Duterte's camp appeared to amplify the conflict. Her remarks about a potential assassination and retaliatory measures further heightened tensions. However, Duterte later issued a statement retracting her more inflammatory comments, accusing the media of taking her words out of context. What's next? The Philippine Department of Justice is investigating the assassination threats. If sufficient evidence is found, legal charges could follow. However, as Bloomberg notes, it is unlikely that either Duterte or her father will face conviction due to their significant public support. Former President Rodrigo Duterte remains a popular figure in the Philippines, and his daughter Sara also enjoys substantial backing. As such, this political drama is expected to persist as a long-running spectacle rather than lead to immediate resolution. Thirdly, a report from the Wall Street Journal offers a glimpse into the complex interplay of politics and economics in U.S. foreign policy. It centers on a Miami-based financier, Paul Lynch, who is making a discreet yet bold move to purchase the Nord Stream 2 natural gas pipeline, which has become a geopolitical flashpoint following the Ukraine war. The bid to control Europe's energy. Lynch, who prefers to operate under the radar, argues that U.S. ownership of the pipeline could serve as a strategic bargaining chip in peace negotiations with Russia and align with America's long-term interests. He describes the opportunity as a once-in-a-generation chance to secure leverage over Europe's energy supply during the twilight of the fossil fuel era. The Nord Stream 2 pipeline, which connects Russia to Germany, is currently embroiled in a bankruptcy process in Switzerland. By January 2025, the pipeline will either reorganize its debts or be auctioned off. Lynch, leveraging his 2 decades of business experience in Moscow, has sought U.S. Treasury approval to bid for the asset. Lynch's unique position. What sets Lynch apart is his ability to navigate the intricate dynamics of Russian business and politics. His previous success in acquiring Russian assets at steep discounts, including a Swiss subsidiary of Russia's Sberbank following U.S. sanctions in 2022, demonstrates his acumen in high-stakes international dealings. However, Lynch's ties raise eyebrows. He is a major donor to former President Donald Trump, which could influence the U.S. government's stance on his proposal. Critics question whether such a transaction is in the national interest or merely benefits a politically connected elite. Geopolitical intrigue. Lynch's pursuit of Nord Stream 2 underscores the geopolitical stakes. He believes few investors will participate in the bidding due to the pipeline's tangled political implications. Potential competitors could include Russian proxies, Chinese firms, or entities opposed to U.S. interests. The pipeline, valued at approximately $11 billion, has drawn attention not just for its monetary worth but for its symbolic significance in the West's struggle with Russian influence. Ownership by an American investor could shift the power dynamics, making it a strategic asset for the U.S. and its allies. A strategic or cynical play? The report invites broader speculation. Could this be part of a larger trap? Lynch's close ties to Moscow and Trump prompt questions about whether the Nord Stream 2 acquisition is a sincere strategic move or a veiled attempt to serve narrow interests. Adding to the intrigue is the timing. With the January 2025 deadline fast approaching, and given the contentious nature of U.S.-Russia relations, this story is bound to dominate headlines. The potential involvement of other global powers like China further complicates the narrative. Implications and final thoughts. This developing story highlights the interwoven nature of politics, economics, and global energy security. If Lynch succeeds, the acquisition could redefine U.S.-European energy relations and offer the U.S. significant leverage in ongoing geopolitical disputes. However, the situation also raises ethical and strategic concerns. Does allowing politically connected financiers to acquire such assets serve the broader national interest? Or does it deepen the perception of crony capitalism in America's approach to foreign policy? The Nord Stream 2 saga is far from over, and its outcome will likely reveal much about the intersection of global power, wealth, and influence. As the January deadline looms, this fascinating case warrants close observation. Finally, let's focus on China's high-speed train. A recent report in the Wall Street Journal sheds light on the massive growth of China's high-speed rail (HSR) network, which is poised to surpass 30,000 miles. While many view this as a monumental achievement that demonstrates China's rapid modernization, others argue it could be setting the stage for a future financial crisis. The article delves into both the political and economic implications of China's high-speed rail investment, raising questions about whether this ambitious project is truly an economic boon or a looming financial burden. A modern miracle or a costly white elephant? China's high-speed rail network has become a symbol of the nation's progress, particularly when compared to the U.S., where high-speed rail has never materialized. Under President Xi Jinping, the country has continued to expand this massive public works project, which many Chinese citizens view as a sign of national pride. However, the Wall Street Journal questions the sustainability of this expansion, highlighting the mounting financial risks and the potential for this infrastructure to become a money pit. The article provides a snapshot of China's high-speed rail project, which began as an ambitious plan to build a 10,000-mile rail system connecting major cities across the country. 12 years later, China now boasts the world's largest high-speed rail network, but with its growth has come a staggering debt burden. As of 2024, the total cost of building and maintaining the system has exceeded $500 billion, with the National Railway Group's debt nearing $1 trillion. The rising costs. Despite the undeniable benefits of faster and more convenient travel for millions of Chinese citizens, the financial strain is becoming evident. The Wall Street Journal reports that the China National Railway Group, CNRG, responsible for managing the high-speed rail system, has accumulated substantial debt. With a yearly debt servicing cost of $25 billion, the company is under pressure to keep the network profitable. Yet, the challenge of boosting ridership, especially with a declining population, could make these financial targets increasingly difficult to meet. In rural areas, such as Fushan County in Sichuan Province, the local population is shrinking, yet new rail lines are still being built. Despite the small demand for high-speed trains in these areas, new stations are opening with little foot traffic. This points to a larger issue. Many of China's new high-speed rail lines are duplicating existing routes, adding even more financial strain. The debt spiral. The crux of the issue is the financial sustainability of such massive infrastructure spending. With China's economy facing demographic challenges, including a population decrease of 200 million people over the next 30 years, the potential for future high-speed rail routes to remain underutilized looms large. Many experts are concerned that the billions of dollars invested in the rail system could have been better spent on other infrastructure needs or innovation-driven projects that might offer higher returns in the long term. However, President Xi's government views this as an essential part of the country's economic growth strategy. While these investments have bolstered GDP in the short term, they have also created a massive debt burden that will continue to grow. In a nation where infrastructure investment already makes up about 42% of GDP, much higher than the global average of 26%, this large-scale spending raises questions about its long-term economic viability. Geopolitical and economic implications. The Wall Street Journal article emphasizes that this debt crisis is not just a Chinese domestic issue, but one that will have global repercussions. China's high-speed rail network has become a prime example of how infrastructure projects can be entangled with political and economic considerations. The push for further expansion into less populated and economically viable areas could lead to greater debt accumulation without significant returns. Additionally, China's real estate developers, often tied to these high-speed rail projects, are also carrying substantial debts. Some experts suggest the total liabilities in the sector could exceed $10 trillion. In this context, the high-speed rail system could become another huge debt black hole in China's economy, comparable to the real estate crisis that has already gripped the country. Is this a debt trap in the making? The Wall Street Journal suggests that while the high-speed rail system has undoubtedly transformed travel in China, the enormous debt associated with it is starting to look unsustainable. With government debt at record highs and the railway group unable to generate sufficient revenue, the project risks becoming a significant financial burden. The broader question is whether this massive investment will pay off in the long term. Critics argue that the country's excessive focus on building out high-speed rail, rather than addressing more pressing issues like technological innovation or the restructuring of older infrastructure, is misallocating resources. The debate around China's high-speed rail serves as a reminder of the complexity behind large-scale infrastructure projects. While they can be symbols of national pride, they also require careful financial management to avoid becoming a drain on the economy. My thoughts and discussion with readers. I'd like to share a few thoughts based on this Wall Street Journal article. High-speed rail as a revolution in travel. It's undeniable that China's high-speed rail network has had a profound impact on domestic travel, especially in remote regions. For rural populations who previously had limited access to fast transport, it has opened up new opportunities and connected communities in ways that would have been unimaginable a decade ago. The risks of overexpansion, however, the rapid and often unrestrained expansion of this network could lead to problems in the future. The issue isn't just the creation of new rail lines, but the lack of thoughtful planning. Building redundant lines in low-population areas where demand is limited might not be sustainable and could lead to a financial crisis down the line. The debt burden, as the article points out, is already massive, and the question remains, who will bear the cost of repaying this debt? Debt and future growth. The enormous debt tied to the high-speed rail system has raised serious concerns, especially given that China's economy is already under pressure from a declining population and an over-leveraged real estate sector. While the government's focus on infrastructure spending may provide short-term growth, it could create long-term challenges for economic stability. This article is an eye-opener and adds a lot of fuel to the ongoing discussion about China's economic future. The question remains, can the Chinese government manage this debt and continue to fuel its economy with these large-scale projects, or will they face the consequences of overextending? I'd love to hear what you think. Do you believe the expansion of China's high-speed rail is a smart investment for the future, or is it a looming financial risk? Feel free to share your thoughts in the comments. That's all for today. Thanks so much for watching. If you found this video helpful, don't forget to hit the like button and subscribe for more updates. I look forward to seeing you in the next one.